Enjoy your meeting.
Hey everybody, good afternoon. This is David Blake with our Tuesday Tech Talk. Sorry I wasn't available last week. I was on vacation. But today we're going to quickly review the last week or so. We had a lot going on. If this is your first time joining us, we're going to look at the different indexes, some support and resistance areas, try to identify some sectors that might lead the way higher or lower in this case. And then after about 20 or 25 minutes, we'll open it up to some questions. I've got a lot to go over today because we've been off for a week or so. So let's jump right in here.
Just a reminder, today's meeting is being recorded.
Okay. First off, the market posture went to bearish on November 2nd. We finished up this last Friday with a CTI of -6. The momentum index fell from I think it was a -1 to a -7, which is also negative. And we also have seen the strength indexes, which we published all this information on the Friday market letter that comes out Friday after the close. The strength indexes were also down for a third straight week, and they've fallen from about a 75% to 10 to 15%, depending on which ETF we were looking at last week. And basically, the strength indexes are kind of they kind of offset and give us a check against the NYSE AD line, which is also a leading indicator. But the strength indexes kind of measure the buying and selling pressure on the ETFs and the overall market by looking at volume on up days and down days. So when that's falling, despite a rising NYSE AD line, you kind of have to let the two balance out against each other. So that's something that we're looking at is also negative. Now the CTI is projected to stay negative into October. If you're new to the webinars, what this means is we project a weak period in the market over this time period. It doesn't always mean that the market's going to have a correction or a big pullback, but it means that at worst case, the market's more likely to go sideways to slightly down than to break out the new highs when we have a negative CTI. However, when we use the momentum indicators, momentum index and the sentiment index and strength indexes with the CTI, which measures cycles in the business cycle and all, and the market, year to date, the Dow Jones is up about 4%. Yet, if you were long and short the CTI and not being leveraged, you're up as of last Friday about 15.5%. Okay, the previous year the Dow Jones was down 2%, and the market edge long-short approach was up 18.2%. And we've talked previously about where if you work with the CTI and buy the triple leveraged Dow, SPY, S&P 500, NASDAQ, and R2000 ETFs, as of yesterday, going long and buying the short one and the long one on those, you were up 43% year to date. So that's going. We did buy the short ETFs, the triple leverage on the 2nd of September, and right now they're up about 2%. So that's again, as of yesterday, they were up 43% if you were investing that with us. Okay, we'll look again at the CTI next week since we're in another negative period for the market, and we'll look at how we measure that and what we can expect going forward with this kind of high volatility area that I think we'll probably be in over the next couple of weeks. But right now, let's take a look at what the index charts are telling us. We have an FOMC meeting tomorrow. It starts today, ends tomorrow, to determine if a rate hike is going to be in order. That could be a game changer for the market looking at it over the next few weeks. Okay, we got a little pointer here. Okay, there's a lot going on in this chart. This is the Dow Jones. The first, what we see over here is we're seeing the Dow Jones on this orange moving average line, which is the 100-day moving average. We've seen this area tested 7 days in a row with the Dow. We're up a little bit today. I would expect to see the market give back most of what we gained just like yesterday today. Whether the 100-day will hold or not, I'm not sure. The next support zone down here is pretty significant. Although I have my target for the short term is 17,850. on the Dow. I think it's more likely that we'll continue on down and test this 200-day moving average, which also represents a 61.8% retracement of the move off the Brexit low, and also a 38.2% retracement off the move of the February lows. Now, whenever you see a conjunction of these several lines from the Fibonacci retracement things being put on here, that's usually you want to pay attention to that as they convene together. In this case, they're convening also with the 200-day moving average. The more lines you get connecting in one area, the stronger that support area is. And I think that that's probably a worst-case scenario where we'll go this go-round. At least at this stage, I think that's probably where I think you could come in to start to buy the market, and you should see some improvement going to that area. Okay, as far as the technical indicators go, we see a negative read in the momentum measured by the 14-day RSI down here. It peaked out with the market over here and has worked its way lower to sideways going forward. Now, you also see back here, and we've talked about this before in the past, you always want to see the 14-day RSI stay above the 40 level if you're in a bull phase. If it begins to break below 40, and in this case we broke down about a week or so ago down to 26.8, it means we've entered a bearish phase. Now, what reverses that, as long as this stays below 70, that means we're probably still in a sideways to down market. And if it goes below this 40 again, that probably is another confirmation that we're in a bearish phase. We also see the MACD-LT, which is more of an intermediate term trend identifier. We also see that that's gone bearish here about 2 weeks ago. It's still working. It actually looks like the momentum to the downside is increasing there. And over here, this is a 30-day stochastic that I use, which signals when it crosses the 50, it signals a reversal and change, or a change in the trend. And when it goes below 20, it's confirming it's a bearish trend, and when it goes above 80, it's confirming it's a bullish trend. We see that that's also down here confirming that for the Dow, it looks like we're probably going to be sideways to lower at this stage. Now, volatility picks up, which I expect it to do over the next few weeks ahead of the the election, and also with tomorrow's thing. You'll probably see some whips around here. If you get a big spike tomorrow because of no rate hike, maybe you get up here about 18.3 or so. You probably won't get to the 50-day moving average, but I would lighten up, or at least maybe buy yourself some protection to the downside at that rate. So we'll see what happens here. The third quarter earnings start coming in at the end of September also, and they're back being projected to be negative currently. So traders are going to be, whether or not earnings can move into the plus column for the fourth quarter, again, they'll be looking for, listening to see what happens when earnings start to come out, whether they're going to be, what's going to be happening next quarter. Okay, here's the S&P 500. Again, looks the same as the Dow Jones did. You're bouncing off this 100-day moving average down here around 21.25, somewhere in that area. Today we're at 21.43, so we're still stuck in this little trading area. Break below this area, this 100-day, is going to open the door down to this 20.65, 20.75. And again, with playing Fibonacci's off the February lows and off of the Brexit low, you get a convening of two different Fibonacci lines. Plus, it also coincides with the 200-day moving average. So this area would be my downside target at this point, and I would expect that, at least at this stage, to hold. As far as the technical indicators, you have the exact same thing going on as with the Dow. Again, you broke below 40 down here and got into 20s again on the 14-day RSI. MACD long-term is also bearish, and you're kind of bouncing on here around this 20 area to see whether you can confirm a bearish phase on the S&P. Okay, the NASDAQ looks better, but it's still showing signs that we may be a bearish move may be coming into play here. So far, we've been testing the 50-day moving average, and it also that will open the door to at least the 100-day moving average, and a 5,000 is right around where the 100-day comes in. That's my initial target to the downside on that. That also coincides where we had a little bit of a double top before we broke out here going forward. And again, with these Fibonacci retracement lines, you'll see that they oftentimes, even going backwards, you'll see where they'll connect where there were some areas of resistance or support previously. But the indicators so far, they're kind of mixed. The 14-day RSI has so far stayed above 40, which is bullish. That means we're still in a bullish phase at this stage. But the MACD long term, it's flat, but a little bit bearish. So you got to kind of watch to see if this is going to pick up on any selling. See if we can keep the positive momentum. And the stochastic oscillator is whipsawing you around a little bit like this. It didn't quite get above 80. It almost did on this little bounce back. And we'll see if that turns around over here. So it's kind of giving you a mixed signal. You can't look at the NASDAQ also without looking at the Philadelphia Semiconductor Index. That has also outperformed quite a bit. It still looks in decent shape, but it might be pulled back by the broader index if we have a sell-off. And as you can see over here, this may indicate a double top. We'll have to see what goes on. If it does, if this comes back here and takes out the 50-day, that probably means that, again, that you're going to have a little bit more of a sell-off. This thing, I would look probably for it to come down to the 720 area. That gives you a ascending trend line, which comes in here and kind of follows the 100-day moving average up here around 720. You came back up here on this move almost to the 80 area, so you're still bullish, but it's not confirming that we're ready for a move higher. You see over here where we crossed above 80 and stayed up there, you had quite a move from here all the way up to there. So usually when you see that above 80 on the 30-day smoothed out by a 3, that's usually a good sign that you can stay with your holdings. In this case, it's trying to get up there, but if it rolls over a little bit again, that's probably going to indicate that we'll be heading down. If it crosses 50, then that means that the trend is changing. Okay, lastly, we're going to look here at the Russell 2000. Again, it looks a little bit better shape than the broader market. It's also struggling to hold the 50-day moving average. It's closed below it a couple times over in here, but yesterday we were back above it. Today we're flat, so it's underperforming the broader market. The Dow's up about 0.25 percentage point, and Russell 2000 is well, now we're getting ready to go go negative as we're speaking. So it's still struggling with this over here. You kind of want to see the Russell 2000 outperform, but technical indicators again are also showing some negative divergence and beginning to roll over, showing some signs that we may be moving into a bearish trend area. I would say I would look at this 1180, where we have the ascending trend line and the 100-day moving average on this also is probably where you'll probably see some support coming in on the Russell 2000. Okay, next one we're going to look at. We look at this pretty much every time we get in here. This is the Dow Jones Transportation Index. We've been saying for quite a while that upside is limited for this market until if the transports don't participate. You can see here there was a reason to get a little bit excited back here a couple weeks ago. We thought we were going to see a breakout to this area. There was on the weekly chart, there was a reverse head and shoulders, but we didn't get the breakout. A lot of times you'll hear us say, okay, if it closes up here another $1.50 on a stock or something like that, that's when you want to buy it, because you get in here and you go, okay, we're going to break out the new highs. Well, this resistance area in this case it held and this thing rolled over. So sometimes it's better to wait for the breakout to happen, then you're not stuck in the trade waiting for it to either come back up to the breakout thing or whether it just it was a failed breakout. You probably want to be out of it. But you can also see the technical indicators are rolling over here. 14-day RSI is kind of going sideways. I also see the MACD long-term also going sideways. So there's just no trend. You're stuck in this trading range, and until you see as far as I'm concerned, I think that you want to see at least 8150 to 8200 before you start to get excited about the broader market going to new highs. You want to see this start to pick up. And at this point, we've had 1, 2, 3, 4 tests of this resistance area right now, and that's kind of a negative to me. The more it bumps into resistance or support, the stronger that is, the more relevant it is when it finally does break out. So once we do see that breakout, it's going to be a signal for the whole market to maybe get a little bit more bullish. Okay, just in summary on the indexes. I see the market looks like it's going to face a few headwinds. We've got the election, we've got the rate hike possibility, we've got seasonal volatility in September. We have a bearish CTI occurring right now. My thoughts are on tomorrow's action that the Federal Reserve is damned if they do and damned if they don't. What it means, I think if they don't raise rates, and this morning there's only about a 12% chance of a rate hike by economists, and the CBOE FedWatch futures is showing about a 15% chance of that. I think if they leave rates unchanged, we could get an initial spike just to get it out of the way. I think traders will interpret that as whether or not the economy may be slowing. In this phase of economic recovery, recession is usually in order, but in this case, the zero rates have stretched it out again a little bit longer. But I think that would we could see some selling off. I think the traders will probably sell an initial spike. If they do raise, of course, we'll probably see a pullback at that point too. I don't think the market's prepared for that. And if they don't, then the market has to look forward to a possible December rate hike, which also puts more uncertainty on the market, which will kind of put a little damper on the upside. So I don't think the Fed's going to raise ahead of the election. I'm on the camp that they stay, leave things unchanged, and they want to appear neutral for the going into the election. But I don't think that we'll get anything tomorrow. And again, if I would fade any kind of initial rally on if we get one after they announce that. Okay, usually we look at a few of the sectors after we look at the indexes, and I'll touch briefly on a few because I've already spoken about 20 minutes. I don't want to tie up too much time. So if you have a couple questions, you can start putting them in. But where I would look to buy, because I think once we get this pullback, we will be setting up for probably a pretty good move in the Dow afterwards. First, my favorite sector right now is the here we go, the tech sector. You can see over here on this resistance line where we had 1, 2, 3, and then we came up here at this test time. We finally broke out in July. The tech sector to break out to new highs. That kind of coincided with the Philadelphia Semiconductor Index. But we're starting to see some negative divergence in this. As you can see, this thing's starting to work higher. You can see the 14-day RSI showing momentum is slowing down here. You can also see that although it's flat, the MACD long-term is also kind of rolled over a little bit, which is starting to show negative stuff. We bounced back up on this initial spike above 80, but we came down here the last couple of days, so we didn't get confirmation on this more than a day that tech sector is going to keep on rolling. But I would, probably be looking at that. If we could get a pullback in this, back to around this 45 area, which is the 100-day moving average, that's probably where, if you want to, where you'd want to start buying some of these semiconductors and some of the other maybe big tech names at that stage. I also like the healthcare sector, not so much the big drug companies. You still have, this is kind of a tricky sector because with the big drug stocks, they got kind of expensive due to their high yields, and you also have some, if Hillary would get elected, I think you'll probably have some more restrictions on drug pricing and all, and that would be bad for, especially for the bigger pharmaceuticals. But I do like the biotechs. I've been recommending the biotechs for several weeks. If you look at this next chart, this is the iShares NASDAQ Biotech Index. You had a heck of a pullback down this thing. You lost almost 50%. But we've been bouncing off here. You have a double bottom in this case on that, which is kind of a nice bottoming signal that it was time to move higher. We came up, retraced 38.2% of this whole move down. We bounced back to support at the moving averages, and now we're back up to that resistance area. If we can break above 300 on the IBB, which is the symbol for this, I think you probably get a retrace up here to this 320 area, a little bit higher than that, which would be a 50% retracement. And then you'll kind of have to see how much more oomph it has behind it to see whether we're going to break out of there. But this is another area, especially the biotechs, that I would be looking at to add to positions on any type of a pullback. In this case, maybe around to the 100 to the 200-day moving average. If we sell off a little bit, I would start to buy some. I would have some names that I would want to buy or add to at that stage. Okay, the financial sector. We also this is another kind of tricky one. You've had investors have had the rug pulled out from under them several times. Every time there's hints that we probably should raise rates. You'll see everything kind of move a little bit higher, and once they get to the point where now they're not going to do it again, you start to sell off. I don't look at the financial sector, XLF in this case, as something you want to buy for a trade. In fact, you're more likely to get more of a pullback here tomorrow, and also with this Wells Fargo shenanigans going on, I think that you could probably get a little bit more of a pullback in that. Now, if you have your own chart, make sure that you have adjusted XLF for the spin-off or special dividend that they had starting today. We're now, instead of trading up around 24, 25, they spun off the real estate investment trust out of this sector yesterday, and so now we're trading about 19.2. If you look at a charting package that hasn't made the adjustment, you're going to see a big drop, especially in the indicators that are going to show a big drop in everything and give you a complete sell. I think you probably get a little bit more of a pullback on this, especially if we don't get a rate hike tomorrow. I would begin to start to buy some of the financial sector at this stage, more for the long term because they pay a nice dividend, and they've been beaten up pretty good already. But if you can get a little bit of a move down to this area, I would add to some of the better ones, the regional banks, and maybe like the J.P. Morgan. Maybe you buy Wells Fargo on this pullback. It's already had it's outperformed up until recently. So I would look at these more for a longer term play at this stage. Okay, industrials. I've been lukewarm on this for quite a while. Although they broke out to a new 52-week high, but you're starting to see a sell-off again. This little sell-off was in anticipation. Are they going to raise rates or not? Because when that happens, you start to see the U.S. dollar get stronger. And we're battling we're trading right now in industrials below the 50 and also below the 200. You do have an ascending trend line, which we're kind of at right now. But a market pullback, you might see this come back down around this 55 level, or maybe even close to the Brexit level. And I would buy down here on a big pullback. But again, even if we just get a little bit of sideways movement because of no rate hike, the dollar maybe pulls back a little bit. You're still facing in December some problems where you're going to have like currency manipulation, that kind of stuff, where it's going to be cut into their profits. So I'm still just a little bit lukewarm on that. If you could buy some of the industrials that do most of their business in the U.S., that might be a little bit better. Okay, the next one we're going to look at real quick is the energy sector. We actually talked about this a few weeks ago where we had kind of a reverse head and shoulders were starting to happen on this thing. But then now you see we're back up here in this trading range, kind of working, edging a little bit higher. But I don't think you're going to see much higher than $50 on oil over the near term, intermediate term. I think on pullbacks, in this case, if you could pull back to the 200-day moving average, where if you when you get oil down to around $40, you maybe add to the refineries and some of those positions. Whether it was for a short-term trade, you could probably do that with these. But otherwise, if you're a little bit older and you're looking still for some dividends, you get the ones that look like their earnings have kind of turned around. The stock's bottomed out, and since we've had such a big pullback on this, you can buy some for the longer term. Some of the Halliburtons and Schlumbergers. There's a couple other that we could talk about next week that I think could be bought in here also for a longer term play. They're still paying a decent dividend. That look like they're probably more likely to keep the dividend in play. Okay, here's another one that's done pretty well, but it's starting to break down. This is the materials sector. We've fallen below the 50-day and the 200 and the 100-day. When this happens, you're probably looking back at least for a pullback to at least the 200-day moving average here, which is going to coincide with the Brexit low. Again, that move down to here also is showing that maybe the economy is not quite as strong as we think it is. That would be one to keep an eye on. You have the 30-day stochastic trading well below 20, so you actually it's confirming that the trend is down on the materials. I wouldn't be looking to aggressively go into that sector either. Next, we have the consumer discretionary sector. This would be some of the retail, car, auto stocks, housing stocks. You broke down below the 50 and 100-day. You're fighting support down here at 78 on the 200-day moving average. If that breaks, you could get a pullback down to the 50% retracement from the February lows. and that also coincides kind of with the Brexit lows. You have a breakdown on your technical indicators. I do like some of the specialty retailers in the consumer discretionary area, but in general, I'm not sure you want to aggressively be buying that, especially this is kind of also telling you that maybe the economy could be slowing and that the consumer is not quite as strong as they think it is. Consumer staples, we've pretty much been telling you to sell from over in this area here on. The reason I don't like this, and I wouldn't be buying these on a pullback, is mainly because the sector is still overpriced. So even with this pullback, these stocks, and by these I mean your Colgate, your Kimberly-Clark, those type of stocks, your Procter & Gamble, you're still trading at about 19 to 20 times earnings. They do pay a nice dividend, which could keep it going sideways for another month or so. But if you break down below this 200-day moving average, you're going to come on back down here even further. These things normally trade at about 12 to 13 times area or earnings. So I would not be buying these aggressively on a pullback because at this stage, if they break below 200, you could be going all the way down here to this 50 area and get another 10% or so. You do have the 30-day stochastic again below 20, which is kind of confirming that you're in a bearish trend on that. And lastly, this is another tricky one. This is a utility spider, and with rates beginning, if we're in such a great economy and you're starting to see the promise of rates to go higher, you wouldn't see this thing starting to show a little bit of strength again in this area. This would have already been falling off pretty aggressively. But I think that without a rate hike, this thing can go sideways. If you start to see it move up a little bit, that could be telling you again that the broader economy is slowing and that a rate hike in December may not even be coming. In that case, you can see the utilities maybe work their way a little bit better, and you start seeing some improvement also in momentum. And also you can see the MACD long-term showing signs of turning up on the histogram down here. So I would, if I own the utilities, I wouldn't be selling right here. I probably would be holding. You probably got a nice profit. But I think I would, if the market begins, if you start to see these things break below the 200-day, maybe you start to lighten up at that time. But I think if you're holding these right now, I would continue to hold. This is showing you that there may be still some traders starting to take on a more defensive posture again, and so this is something I want to watch. So, okay, one last thing before we open it up for some questions. This is something that you can get from the Department of the Treasury. This shows the yield curve spread, and what's important here is this thing coming down here. We're getting close to this 1%. As long as it stays above 1%, this shows the difference between the between short yields and long yields. When you get an inverted yield curve, which happens down here, usually almost always, like 9 out of 10 times, it's forecasted a recession within the following year. You see it's happened here and here over the last 16 years. Now, once this thing breaks below 1%, you need to have it. It's a red flag that the economy, we could be going into recession. At this stage, we're still fine. As long as we're above 1%, it usually indicates that we have a less than 20% chance of being in a recession a year out. But we're getting to the level where you at least want to keep a watch on that. So if you can get these things, you can go to the Department of Treasury's website. I don't think they probably like where they misspelled Treasury here, but that's government work. And so just keep an eye on that once in a while. I'll bring this up also as we go forward over the next couple of weeks. If we start to see this break below that, that certainly will be a red flag that we'll all want to know about, and it would we want to reposition our portfolios. So I've run out of time again. I tried to make it a little bit long, but I do think that we had a lot to talk about today, and what I think is probably going to happen over the next few weeks. I would stay on a defensive posture, look to buy biotechs and technology stocks on any pullbacks. I wouldn't be overly aggressive. You should have made some decent money over the summer with the summer rally that we pretty much were dead on that thing. I think that now we just kind of lighten up on some stuff and stay a little bit more defensive. So I'm going to open it up here and try to share the screen a little bit. Okay, good short ETFs, SRS, and has Wells Fargo bottomed out. Okay, as far as the ETFs, I'm going to give you 4 of them that I like. When I buy these, and we do this with the CTI, when I talked about the 43% gain year to date, I like to spread it out. Say if I have $20,000 that I'm investing in the leveraged ETFs, I will split it between the Dow, the S&P 500, the NASDAQ, and the Russell 2000. Going back to May, the Russell 2000, if you had the triple leverage, you were up, I think it was 20% from the end of May through September. The NASDAQ was up 18.9%. The Russell was up almost 29%. That's right. The NASDAQ was up 18.9%, and the Dow and the S&P 500 on the triple leverage, you made 15 to 16% on your money from May 29th through September 2nd. But what the symbols for those, for the Dow, I use SDOW, SDOW. For the S&P 500, it is SPXS. Sam, Paul, xylophone, Sam. For the NASDAQ, it's SQQQ. For the Russell 2000, it's SRTY, Sam, Roger, Tiger, Yellow. And those are the ones that we put into our leveraged CTI portfolio. Okay, I'm up 11% in SPV, in good hold through this downtrend. Per your comments on biotech, again, I like the biotechs. You're getting a little stretched. I'm going to go ahead and share the screen right now so we can look at a couple of these charts. Let's see here. Well, where do I go to share this thing? It used to be right here. Oh, I got to close this out. Okay, hold on 1 second. Bear with me just for a second. Okay, write these down. Okay, we should be good now. Here's this chart. You see that? Okay, first let's look at this SUPN. SUPN. Apparently we don't follow that. Not sure why. Oops, oh, sorry, maybe you got the wrong symbol here. Just typing. No, that's it. Okay, well, we don't follow that. If you want us to follow it, you'll need to send it in with a email, and we can add it to what we follow. Okay, someone asked about Wells Fargo. Has it bottomed? Well, let's see here. Let me try getting something else. Here we go. I would be a little bit, I'm not so sure I'd be grabbing it right here. Now you have a double bottom down here at around 44 and change. Let's go back even further than that. Let's go back 2 years. Okay, this is a pretty good bottom, this 44 and change. This down here, this is the 50-day up-down ratio. When you see this means when you see a big drop like that, institutions are dumping that thing. So I think you probably can work your way a little bit lower. You got the long-term MACD also just went negative on this. Not sure. Yeah, you know, maybe around this 44 area, you buy a half position. If it breaks below that, you could go down to 40. But I don't think you'll see that because of the dividend, and also that they actually outperform some of the other banks going back. But right around that area, you might look to see to start to add a position. Now, you're not in any hurry to buy this thing, mainly because if they don't raise the rates tomorrow, the banking stocks could also get a little bit of a sell-off. So you got a double. You got trouble with this thing just because of what's going on in front of Congress today, and then the fact that they don't get a rate hike. That's going to at least send this down here, this 44 area, where I think you can buy it at that. At least start to buy a half position If it breaks 44, you wait and see where it goes to. But I don't think you'll do that. It's not crazily priced. You still have a low PE on all these banks, and they're just starting to make some money. Okay. What's this? Okay. How do you feel about telecommunications? Oops. XTL. My bad. XTL. Well, let me get the symbol on that. XTL. That's it. Not sure why it's not coming up. Telecommunications have done fairly well. See, what today we're down almost 1% though, and one of the problems with the telecommunications area is that they're overpriced. You have your stocks like AT&T and Verizon, and they're doing well, but they still are overpriced. You usually that sector is another one that trades at a lower PE, and because of the high dividends, they're overpriced. So on any pullback, they're probably going to come back further than some of the other sectors. I wouldn't be aggressively buying them because they have gone outperformed a little bit. So you just kind of, I'm not sure why it's not coming up here. Anyway, again, I would with the XTL, I don't have the chart in front of me, so I can't guess where it bottom. But again, they're down 1% today, and I just don't like. I think that's an area that you want to aggressively buy because they're overpriced. Let's see what this is. Okay, would you hold on? All right, Micron. Let me write these down real quick. Sorry to make this so long. SPG and Cisco. Okay. Look at Cisco first. I do like this if you're in for a value, if you're a value player, if you're an old guy looking for some dividends. I think Cisco is one you can buy. It's going back and forth here with the 50-day moving average. So far, it's holding. If you get a pullback in Cisco, maybe I think the downside is less than 10% on any type of a pullback. You do have some profit taking in that coming down in here. A little bit of slowing momentum. I don't think you're not going to break out the new highs. So if you're looking to buy this for a breakout trade, you're not going to get that. But I certainly would look to buy Cisco on any kind of pullback, especially if you see it break below the 50-day. I know it's paying a decent dividend, and the PE is historically is very cheap right now. So I do like that. SPG. Simon Property Group. Again, with the REITs, this is one of the better REITs that you have. I mean, they're good. You're starting to see a little bit of a pickup down here. Not sure what happened here the last couple of days, but you're still above. You're back above. I'm trying to hold this 40 on the 14-day RSI. I don't think you aggressively buy in here because the problem with this, if out of the blue, once they start, as soon as tomorrow's over, they're going to start talking about a December rate hike, and that's going to keep a cap on all this stuff. So between a December rate hike on the table and also the election, your upside on a lot of this stuff is just not. I don't think it's worth going into these areas. If you're long this thing and you like the dividends, you're probably okay, knowing that you're probably going to go from maybe 210 down to this 198 area, maybe 202 with the 200-day moving average. But again, I'm not aggressively buying things like that with this going forward. Micron. Okay, you're in the right group on this thing. You've had a couple of days where it's kind of rolled over. Nice accumulation all the way up through here. A little bit of negative divergence here on the 14-day RSI. You peaked out over in this area. This last move has seen slowing and almost ready to go negative on the momentum. You might even think about, this thing breaks down below 16. You might want to think about maybe rolling over on that thing. But until the market starts to sell off, I think you hold on to that. Okay, you've gotten a nice trade no matter where you bought it, unless you bought it over here yesterday or 2 days ago. But I think, Micron, you're in the right sector, and you're in the right category in that sector to boot. Would you sell those and buy back after market goes down, or would you just sell? On those three stocks, Linda, I don't know whether you're trying to go, thanks for that, for the welcome back. I don't know that you really want to just sell everything and presume that the market's going to have a pullback. You know, like I say, when we have a CTI goes negative, you know, if we're getting confirmation that the market is most likely ready to going to pull back because of the negative momentum index and the drop off in the strength indexes. But with these rates, lower rates and stuff, you know, if they come in and say we may not get a rate hike in December, this crazy market could actually spike up due to that, because people will say, hey, we got 0 rates into next year, let's buy everything again. And then you would see a pickup in the telecommunications and the utilities and maybe even the consumer staples. But that's hardly the right reason to be buying a stock and put it in your portfolio and saying, I like these stocks, I like the prospects going forward. You're merely buying them because you think that they're going to go higher because of the 0 interest. So, you know, just because we're negative on the CTI, because of something that gets said like that, you know, maybe the market goes sideways to just barely down. But you know, indications are that we're going to go down. I don't think you want to sell that. I would have my exit points because you should have decent profits on those stocks because of the summer, what we've been talking about. At that point, I think you wait till the market rolls over. I've got a lot of stocks, semiconductors, that I'm holding on to until I start to see them crack. And I have a price in my head that, okay, I'm happy with the profit I got on them, and if it goes to this, I still did well. You know, you're not going to catch the top, and you're not going to buy at the bottom. So that's where we look on that. And I've gone a little bit too long. Next week, what I think I'm going to do, I would like to go over some individual stocks. Probably we're going to be able to tell the direction of the market for sure by next Tuesday, because we'll have the FOMC behind us. I think we also have the Bank of Japan doing something today. So we'll have a couple of events that are going to come out. We have the presidential election debate coming on September 26th. That may give us a little bit of some more volatility. So we'll talk a little bit about some things that we may want to do on this market, and especially if the market did crack, like I think it could towards the end of the week and beginning of next week. We'll see, and we'll again talk about these different support areas. So I appreciate you joining me and hanging on this long. I don't mean to carry on 45 minutes usually, but glad to be back, and we'll figure out how to make some money with this as volatility picks up over the next couple of weeks. Thanks, everybody.